Hello, folks. This is Raj Sastry from Raj Option Trading. Today, we'll cover one of my favorite option strategies. It's called long straddle. This is especially very critical before any big announcements like earnings, FDA approvals, product announcements, and so on and so forth. So, what is long straddle? So you buy at the money puts and at the money calls, basically at the same strike price and expiration date. And we can profit from stock soaring up or plummeting down. When to buy straddle? Why to buy straddle? So we buy straddle because there is an uncapped profit potential, whether stock goes up or down quickly. Max profit potential is really unlimited, and we want stock to move up or down quickly. This is also called plus gamma because we want the movement in the stock. That's why it's any big movements will help this position, and we also profit from implied volatility increasing. Max loss potential is really premium paid. So when to buy straddles? Typically, when you're buying your straddles, your outlook is neutral. You don't know whether stock will go up or go down, but for sure you know it's going to move big either way. And you're looking for increasing volatility with stock price moving explosively either upwards or downwards. And we typically concentrate on stocks with news, earnings, FD announcements, product release. Typically need to happen within say 2 to 4 weeks or so. And we also want to buy when the implied volatility is relatively low, because when the IV is low, because we are option buyers here, we will get a little bit lower price. Duration is really 3 months or more, mainly because we are the time decay works against us, so that's why we want to have enough time to be right. And strike price is really at the money. That's what is preferred for this strategy. And you got to watch out for don't hold this position into the last month, because last month there is a steep time decay. So these are some characteristics of a long straddle. Next we'll look at a quick chart to really understand a little bit more. So if you look at this chart here, this is a quick chart. The way to read this chart is, we have position value here. This is the value of our long straddle, and we got underlying stock itself. Stock can go like in this case 30, 40, 50, 60, whatnot. And what we did here is, stock is at $50 right now, and we bought both calls and puts at the same price. So that's the straddle. So if you look at this solid black line here in the middle, this is the straddle that we bought. We paid 4 plus 5, $9 for this straddle. And as stock price increases drastically up or down, for example, stock price goes to 50 quickly, so we make money. So from $9, our straddle price went all the way to $15. Similarly, if the stock price goes all the way down, say to 40, we still make about $15 because it moved very quickly. So this is talking about the stock movement, and we also call it gamma. Stock moved up or down quickly. So any quick movement in the stock price, which is similar to positive gamma because it moved quickly, it will favor our straddle position. Next, we have to look at the volatility. As the volatility increases, as you see here, volatility here is relatively low, but now volatility increased. If the volatility increases, the stock price being the same, it will basically favor our position. Our long straddle will increase in value as implied volatility increases. And similarly, if the implied volatility decreases, in this case it came all the way here, so our position will suffer a loss. So you can see here it came down from $9 to $5. And if the IV still stays low and stock price remains the same, meaning there is no movement in the stock price, but IV also remained low. So IV remained low in that scenario, we will lose entire option premium that we paid. This is our max loss scenario. In the same way, if the stock shoots up to the stratosphere, for example, it goes all the way to, say from 50 to 100 relatively quickly, we make unlimited profit or max profit. Similarly, if the stock goes from 50 to 0 pretty quickly, we make big profit here too. So this is a strategy where you don't know how the stock will go, but it will move one of the directions very rapidly. So a couple things to note here. So increase in volatility will help because we are net option buyers. Any implied volatility increase will help to increase the straddle price. And decrease in volatility will help the position because as you decrease volatility, basically our stock price will our straddle price will come down. And increase in movement, quickly, the stock movement very quickly will really help our straddle position because we'll make money like we talked about. And one very, very important thing here is we got to resist the urge to take small profits, because if you take small profits, you will be missing the big picture. This strategy is not for taking small profit. You would rather wait, have patience, have psychologically strong mind. So sit through some of these smaller losses and wait for big profit or hitting the jackpot. So this is why straddle buying is psychologically very difficult. That's one of the reasons most people don't buy straddle, because you will accumulate small losses here and there every day as stock fluctuates and comes back to original value. But important aspect here is to have some patience and wait for big news to unfold. And in the meantime, don't hold the position into the last month, because as you hold it to the last month, the time decay will really work against you. So those are some key callouts here. And let's look at one example here. The stock we chose for this example is Stitch Fix or S Fix. And we could take several examples. A couple of my favorites are Tesla, Shopify, and even Overstock, MicroStrategy, which is again a Bitcoin type play. So typically what we would do is we look for the earnings in the calendar. So right now we are on 11/5, November 5th, but the earnings is on 12/7. As you can see, earnings is about a month or so away from today's date. So, because there is earnings announcement, we would like to capitalize and buy a straddle. So we bought a straddle on 11/5 at 134 days to expiration. And for buying this straddle, we will pay some premium. We'll look at that example as we go forward. So if you look at Stitch Fix here on on November 5th, Stitch Fix has a earnings coming up a little bit later, and at this point, the implied volatility is relatively okay. I would say it's at the mid level. We would like to have it a little bit lower, but doesn't matter because there is a event coming up in the future. So with that, I will go to next slide to look at the option chain here. If you look at the option chain, currently on November 5th, the stock price is at 36.92. And if you look at the money, we are looking at 36.92, which is closer to 37 as you can see. 37 call is trading at around $3. I think it's around $4.55. And same story on the put side, is trading around $6 to $7. So let's initiate a position here, and we are buying a straddle. As you can see here, we are buying a at the money call and at the money put, and for this we are paying $12.30. And let's hit execute here. So as you can see here, we are buying a straddle expiring in March, 19th of March, 12:30. We are paying for this straddle. And as you can see here, break-even price is really, stock can go to 24 or 49. Currently it's around 36.92 as we can see. Max profit is infinite, as stocks plummets down to zero or goes all the way to infinity. Max loss is what we paid for the straddle. In this case, we paid 12.30. That's our max loss. Cost of the trade is same as max loss in this example. We are not considering any option commission that we paid. And buying power effect is really whatever we paid for this straddle. So with that, let's look at how our straddle behaved. So if you look at here, we bought the straddle on 11.5 and 11.13. It's about a week or so after we bought the straddle, and we made a small loss, as you can see, $13 loss. This is where I made a point around psychologically you got to be very strong. So you will have a urge to let me take this small loss because I don't want to wait for a big loss. So typically people want to limit their loss and take this $13 loss and close it. But as you can see here, 11.20, one more week passed and we kind of increased our loss from $13 to $38. This is when most people give up because the loss is increasing. And look at earnings day itself, 12/7 earnings. Earnings did not happen yet. It's the earnings day. As you can see here, our loss increased to $88. So you would think, what, I'm done. Earnings is today, but stock is not moving. Let me, take the loss. Fast forward to January 21, and we still have 57 more days to expiration. As you can see here, we made a $3,334 profit. So this is where you got to have very good patience when you are a straddle buyer, and you got to buy straddle for a longer term. In our case, we bought it for 126, as you can see here, or around 3 months and out. So that's why if you buy it for longer term and don't wait till the last month, but this could be a good time to really sell this and take profit. We have 57 more days to go and we made a good $3,300 profit. So, this is a very good strategy for stocks like Tesla, Shopify, and stocks that moves widely, like say MicroStrategy, Overstock, and some of these high flying stocks is a very good strategy, and you don't know what direction it will go, but you are very sure stock will move. So with that, hope this helps. Happy trading.